Raj. It is Sailesh Raj Bhan from Nippon India Mutual Fund. Good morning. Good to have you on the show. So that's my first question to you. How are you folks reading the markets? A bull run that's going to carry on into 2022?
I think, some part of the bull run has certainly happened, right, in the last 12, 18 months where we have seen substantial re-rating. I think we are entering a phase of consolidation where, markets will look at how these larger sectors which have improved in the last 12 months start delivering in terms of earnings. So I think this recent correction reflects some consolidation with an underlying, I would say, a very strong earning environment from a 3-year horizon in India, because last few years have been pretty weak and you have seen an improvement coming through. And when you see these large sectors firing, I think they sustain for a period of time. So I think all in all, strong earning environment over the next 3-4 years should benefit.
So, Sailesh, what we saw in the last earnings season was corporate India's margins being squeezed because of rising inflation. Now, it's a global problem. US 4-decade high. If we've seen the FOMC action, Bank of England has responded with an out-of-turn rate cut. Back home, let's see what all happens. But the inflation, what we're seeing, how would you play with that theme on the markets?
See, inflation is real in the sense, it is coming across sectors and, is certainly impacting or pushing pricing. Corporates have no choice but to push pricing higher. The only point is that, this is happening after an elongated period of 5-7 years of, compressed price increasing ability by corporates. So I think it is in some manner a welcome relief for a large number of companies in terms of their ability to price, especially commodities and things like that. Directionally, the pressure on consumption is there. The reality is that, November generally has been a little weaker. The post-festive season have been weaker in India. And some pressure points because of sharper price increases certainly exist, especially the consumption stress, which is visible today, where you're seeing slowdown in the rural side and, some kind of pressure coming because of the sharper increases corporates need to take. I think the inflation is also getting distorted a bit because we had a very, very weak inflationary period prior to the rebound in the last 12 months. And now you have from a bottom seeing a very sharp change. I think as things normalize over the next 12 months, you would see inflation getting seeped in the sense absorbed from a corporate profitability point of view, and normalized margins should be back maybe in a couple of quarters in India.
Right. Sailesh, I started my career by tracking Pharma, and that time, of course, you were on the front lead in 2008 trying to analyze the Ranbaxy deal, what's happening. That time around, your key argument was that profitability is so high and market cap is so low. How do you make the new change that has happened? Zomato profitability is low, or are the losses higher and market cap is higher? Same with the case with some of the other new listings. How are you adjusting to these changes?
I think most of the new age businesses, I think it's more a function of, how they were valued in the private market. And, some of these are getting reflected in the public market as well. I think we are paying a lot for a lot of these new age businesses in terms of, the kind of upfront valuations we are giving to a lot of these new age businesses. So it's certainly way off than normal. A few businesses certainly have a right to win. So, some amount of premium is justified. But I think we are finding that because the markets have been so good in the last 6-9 months and valuations which a lot of these private companies are getting are pretty high, I think we are finding a flood of IPOs. Some rationalization or reset in terms of how public markets are viewing the private companies who are coming for listing, I think is clearly visible in what happened in the last few months. So our approach is very simple. I think where there is a right to win, we are willing to give some premium and a longer term horizon. But where we are finding that even the business model or the kind of scale and scope of the opportunity is constrained, I think there the valuations are completely way off from reality. So I think we're completely avoiding those spaces. So it's like a mix and match, choosing a few right to win kind of opportunities and maybe giving them a little premium valuation than normal, while avoiding a major chunk of it. 80-90% of these companies certainly don't have at least the contours of being publicly listed companies today, except for the market capitalizations they are wanting to command.
Hi Sailesh, good to connect with you.
Right.
Nikunj also joining. And now Sailesh, in the past you've, let's say, bought into Info Edge, now Naukri. You bought into the whole lifestyle space very nicely. You bought into specialty food. How are you betting on the consumer space?
Consumers still, after a couple of years of consolidation in valuations and all that, and the slowdown in growth, I think valuations are starting to get normalized. I think valuations have compressed by about 20-30% in most of these companies. But I think still growth recovery and rebound is some time away. I don't think it's a very easy journey, because the reality is COVID has certainly impacted lower middle India in some context in terms of their incomes and their savings. So I think some slowdown in consumption seems to be the challenge today, and I think that will play out over the next 12 months. Hence, re-rating for pure consumer staple businesses doesn't seem to be the case. Consumer discretionary, on the other hand, which generally caters to the top 10, 15, 20% of India, seems less impacted. So there, I think there is an opportunity to participate there. Again, nothing is free in the market today. Valuations are not as they were a few months back, or 12, 18 months back, and hence you have to be very picky and choosy. But I think clearly the companies catering to the top 20% are doing well, and I think they seem to be in a much better sweet spot for the next 12, 18 months as well.
Sailesh, you bought stocks like Linde India, and there's a large commitment in the public information if I look at the fund holdings. Are you betting on this entire clean energy, new energy, hydrogen space?
See, some of the investments in the industrial side, which we have done over the last several years, have more been from a point of view of seeing, how economic recovery, volume, manufacturing, industrial activity, capacity creation picks up in India. Because, the underlying factors were there, whether it is low taxation, whether it is very low interest rates, and, things were around that. But with now the policy environment also being favoring, anything to do with manufacturing and investment has a far greater chances of doing well over the next 1 to 3 years or 4 years, because of the weaker performance of the past, and as also the demand shifts, the localization, and all the other factors, China plus one factors supporting this. So we think the fundamental belief of investment over consumption is an important theme in the next 3-4 years, and a lot of our investments are playing into that. So some of the investments play into virtually everything that happens in manufacturing requires industrial gases, or requires capacity creation, or businesses who are building, or capital goods, growth of capital goods happens because of that. So when you look at this construct, I think our focus is towards choosing these kind of businesses which possibly can have earnings which are maybe double or 50% higher than the average index earnings. So, and that is where I think the opportunity for capturing growth remains in India today.
I'm going to spend some time trying to understand your view on pharma. You've been managing a pharma fund. Your understanding of some of the pharma businesses is quite pristine. Split the space for us. MNC pharma, domestic pharma, API pharma. Where do you see growth? Where do you see trouble?
I think the most important segment of the pharma space is the domestic market. It's very clear. I think this is a market which just keeps compounding, completely underpenetrated. Any variable you look at, I think this is possibly a market which can do significantly higher growth than normal for the next 10-15 years. Also, the profitability of this market is very high, or it is very good from the context of the capital required for the business and the margin structure of the business. Also, the underpenetration and the market expansion here. I think both these factors still remain maybe not as good as they were 10-15 years back, but still very, very high. The most well-known fact today is 27 crore people in India are over the age of 50 in a nation which is considered one of the youngest nations in the world, or one of the youngest demographic profile countries in the world. And this 27 crore people, they are growing at about 1 crore 80 to 90 lakhs a year annually. Additionally, this cohort is growing, which creates an enormous market. And with very, very strong brands today, very little challenges to the current domestic branded business, I think this journey is very long. So this is one space which continues to compound, and I think possibly will create the single largest value for the pharma sector. The other important segment is the export-oriented businesses, more on the branded side. India nearly sells their brands in about 15 to 20 countries. with their own field force or their own brands in those markets. And these are comparable, similar markets to India. So these are emerging market opportunities, similar profile as India, and you would be surprised that the pricing there is better than India. So I think the economics there will also come, and this can also grow at 10-15% for a very long period of time. So similar economics also there into play in this area. The third area where the struggle has been in terms of the US markets, where commodity pricing pressures continue to be high, in the sense the commodity business is not able to price it better, the US generic space. But some companies have taken the leap to get into the branded specialty areas. It's a hugely challenging market, but the size of that market is much larger, and some of these businesses can become $1 billion in size with 50% contribution, 40% contribution, which I think is an important opportunity, and few leaders will capture. I think this is not available for everyone, so few leaders will capture. Lastly, in India, you have a very interesting opportunity of the hospital and the diagnostic services spaces. See, this was one sector which suffered a lot because of underpenetration of insurance, because of very high cost of setting up infrastructure, and generally lower incomes versus what was the cost to get a proper medical treatment at a expensive or I would say a full-fledged private sector space. But COVID has really made a big difference in terms of healthcare preferences, in terms of what kind of money will go into this particular sector, the need for capacity, and the whole domestic hospital space is able to price their services also very, very well. So I think this space is possibly coming out of very, I would say, normalized profits to a reasonably strong profit environment. And I think the demand environment is also reasonably good. Obviously, there cannot be excesses in demand, but I think the normal income growth levels and all that are supporting reasonably good growth. Plus, insurance penetration is helping the space. So the private sector hospital space is also working out very well. Lastly, the new tech space, or the online pharmacy and the solution space or the health tech space, right? I think this is just emerging. Still, models are yet to be proven. Any scale in a lot of cases is yet to be achieved. And I think the economics, except in the pharmacy side, I think don't seem to be there at the moment. So these are spaces which we are watching for today.
Sailesh, what was conspicuous by its absence in the list that you just read out and talked about was banks. Can I ask you what your reading on banks is? You do have holdings when it comes to HDFC Bank as well as ICICI Bank, etc. We've all been waiting for the financials to make a comeback.
See, banking clearly has underperformed the broader indices despite having such a large weight. So the underperformance is fairly significant. Interestingly, in terms of their balance sheets, their quality of assets and everything, I think they are as good as they could be. I think coming out of COVID in this particular shape was actually unimaginable when you went into COVID. So from a banking sector construct and readiness, I think it is there. It is just that the over ownership was fairly significant because this being such a large weight in the sector. Also, large weight in the index. Also, if you look at it, the broader market environment is starting to perform. Now, people have choices versus banks, you can choose something else. So I think you're finding that broad basing also, in a way, reducing the attractiveness of the space. On a fundamental front, on a valuation front, I think the sector is well poised. I think there are a lot of banks which are at very, very reasonable price to book and sustainably large banks. And the consolidation of this space where, a lot of smaller NBFCs and all that have fallen away, I think is clearly an advantage these guys will capture. So I think this is an important part of our portfolio theme, along with the consolidation we have talked in telecom. Banking is a very, very important part of the theme.
Sailesh, a very simple question based on the valuation theory. If interest rates will go higher, discounting reduces. Interest rates will go higher. Do you think there could be a case of P compression for some of the so-called quality stocks, and that in a sense is going to be the big trend differentiator between 2021 and 2022?
I think this is what has been now happening now already for some time. And if you look at it, initially very high P multiple stocks where growth rates were very moderate, but the longevity of growth was there. We're getting obnoxious multiples. I mean, consumer staples is one example. So there were 2 or 3 reasons for that to happen. Like one was the interest rate factor, which you mentioned about. The second also was the growth was not available in many other sectors. The growth recovery is a phenomenon of the last few quarters only. And hence, prior to that, this distortion was very clearly visible. I think when you have a choice where growth is coming back, at least from a 3-5 year kind of a horizon, you will find that the overvaluation or excess valuation being paid for some of these large perceived quality businesses, I think can see a significant correction. And I think when there is no money to be made and when you have broader markets performing well, I think you can see significant compression in margins. We have seen some of these quality names trade at 40-50 multiple and also trade at 20-22 multiple when things turn for them. So I think we should be open to this fact that these large quality names which are today in sky high valuations and multiples, as growth starts moderating, you will see them giving away even more. So I think even expecting earning-led growth or returns from those businesses is a very significant challenge in my opinion.
Any new business which has caught your attention? Several new sectors have got created in last 2-3 years. Insurance is now a full sector. AMCs is now a full sector. Internet companies now a full sector. Couple of defense companies have got listed. So you got options to go outside BEL and BML finally. Any niche or a new sector which has got created which is catching your attention?
Other than the sectors you mentioned, one sector which is coming to its prime, I think, is logistics. This was one sector which had promised even 5-10 years back, but this was pre-GST, and so many reasons for that sector to remain subscale were there today. Today, you're finding that this sector is reaching its prime. Large investments are happening, and the need for complete logistics solutions is the way forward. People are seeing logistics as more as a outsourcing service for their own businesses rather than the core service to retail inside. So I think this is one sector which can possibly grow at even much higher growth rates for the next 10-15 years because it's too small from the context of this country. And I think the policies are there. The some players are already emerging. The policies are there. Some players are already emerging. And I think it requires decades of growth to create an organized logistics sector, which I think is today happening as we see.
Sailesh, to be very frank, both the styles, which is high growth and deep value, they both have done rather well for 2021. We can see an instance of State Bank of India and talk about a 60-70% return it has given, and we can talk about how some of the internet tech companies like Nykaa and Policy Bazaar have had a good day. What will be the theme or the dominant theme for 2022? Will both coexist, or will it be a decisive move towards one versus other?
Every 3 years or 2 years, we are finding some shifts in style which work, and primarily it is because of the underlying construct of the market when it changes. So I think we are now back to with broad basing of growth. I think growth at reasonable prices should be a very rational approach to really make differentiated returns. For example, you look at last year where you had the high flying banks actually didn't deliver at all, but outliers which were not favored, the public sector leaders actually demonstrated substantial outperformance, 50-60% kind of outperformance in that year. I think these kind of surprises will be there in the next year as well. And you have a few distressed sectors, challenge sectors, they will come back to normalcy because the valuations are still pretty attractive in those spaces, and the outlook can only improve from where it stands. But I think growth at reasonable prices should be it remains a reasonably evergreen strategy except for the patches which you see. And that I think will possibly be an important, I would say, working style in the next maybe 1 to 3 years as well, not just 2022, but even a little ahead as well.
Okay, Mr. Bhan, we're going to leave it at that. Thank you so much for joining us today live on The Market. Here's wishing you, your family, and the entire team a very happy new year.
Thank you, and wish you all at 18 a great year ahead. Thank you so much.